Is there a chance the Fed could actually raise interest rates? Are they still too low? Maybe the Fed hasn't been aggressive enough. It wouldn't be the first time, and we're not the only ones saying this. The CPI number was hot. Inflation is stickier than ever. Where are prices rising the fastest? When in history did the Fed actually embark on two back-to-back tightening cycles? It actually happened. What caused this? Could it happen again? There are some similarities between then and now. But wait, there may also be some good news when it comes to inflation and in a very significant part of the CPI report that most are just not talking about. The Consumer Price Index was reported earlier this week, and inflation certainly is on the rise. On a year over year basis, the CPI rose 3.5%, the most since September of last year. Core CPI, excluding the more volatile food and fuel components, also rose, in this case to an annual rate of 3.8%, the highest since December. Certainly, we all feel the inflation. Where is it the strongest? We can answer that question in one word: energy. The standard measure of CPI, which includes energy, is rising faster than core CPI. This shows us a tremendous strength in energy. On a year over year basis, the overall energy component of CPI rose 2.1%, which now represents the first increase in at least over a year. Within the energy sector, gasoline is also on the rise. Bad news for those of us at the gas pump. Gasoline is also marking its first annual gain since September of last year at a pace of 1.3%. Electricity prices are also surging, rising an annual 5%. This represents the largest gain since June of last year. Given the resurgence in inflation, could the Fed actually raise rates? Believe it or not, some very important people are now talking just about that. Just the other day, economist and former Treasury Secretary Larry Summers: "You have to take seriously the possibility that the next rate move will be upwards rather than downwards." Additionally, he said, the Federal Reserve may not only have difficulty delivering previously expected interest rate cuts, but could have yet to deliver its final rate hike of the current cycle. And Larry Summers is not alone. JP Morgan CEO Jamie Dimon has also recently weighed in. In part, he spoke about the possibility of interest rates surging to 8% or beyond in the near future. The idea of rate hikes is not just coming from increasing energy prices for the consumer. Producer prices are also on the rise at an annual pace of 2.1%, the strongest since April of last year. And core wholesale prices, excluding food and fuel, are up, this week registering 2.4%, the highest level going back to August. So certainly the manufacturers are feeling the inflation alongside the consumer. Could the Fed actually raise rates again? When was the last time the Fed embarked on a tightening cycle, paused, and then hike rates again? To answer that, we have to travel back in time to a time of classic TV sitcoms, classic rock, the majestic luxury sedans, and timeless movies. We're going back to the late 1970s. In 1977, Fed funds stood at 4.2% with inflation around 5%. But inflation and rates didn't stay down there for very long. By early 1980, average interest rates stood at 20% with a year-over-year CPI readings at 15%. Those high interest rates eventually took hold and inflation began to fall. But the story's not done here. The Fed once again began another round of interest rate hikes, this time touching 22% in 1981. What was the cause of these additional Fed hikes? Well, like any historical event, it's not so simple, and the topic certainly deserves more time than we can commit here today. But one of the primary reasons for the resurgence in inflation in the 1970s was due to skyrocketing oil prices. Between 1979 and 1980, crude oil was on the rise. From $70, prices surged to over $140 at their highest point. In fact, between April of 1979 and April of 1980, oil prices doubled. The energy inflation helped spark the central bank back into action. This point is especially relevant because oil is once again on the rise, rallying from $70 to now $85 a barrel. Tell us what you think. How high does oil have to go to kickstart the Fed back into action? With this in mind, the increase in CPI energy now seems that much more ominous. But we promised you some good news, and we will deliver. The Consumer Price Index measures a change in prices in several categories, the largest of which is housing. A significant portion of the housing CPI is comprised of rent prices, but the CPI report measuring existing rental contracts is not current. Given a typical rent contract is signed for a year, this data is somewhat delayed. The CPI rent is reporting transactions that may have occurred as long as a year ago. We should consider current rent prices. They're much more relevant. In yellow, current rental prices published by Zillow compared to the rent prices derived from the CPI reports. There's almost exactly a year delay between the Zillow rent and CPI rent prices. In March of 22, rent prices measured by Zillow reached their peaks. The CPI did not reflect the surge in rent prices until April of 23. Given rent prices extracted from Zillow have declined from 7 to 4.9% in the past year, we can expect the rent component of the CPI report will continue to decline over the course of the next year. We're facing a torrent of crosswinds within our financial system. Surging inflation is forcing the conversation of possible future rate hikes, while at the same time, declining rent prices may offer some refuge from the turbulent economic seas. But inflation is only one side of the Fed's conversation, the other is employment, and the recent data is troubling to say the least. We recently took a hard look at the jobs numbers. The link here shows you exactly what we uncovered.